Now, following the commencement of the FX interbank markets, which has been the story on the lips of analysts, investors, and all the market watchers, what took place at the FMDQ OTC Securities Exchange this week? We saw the CBN holding a special FX intervention auction where months of $4.02 billion FX demands were cleared at 280 naira to a US dollar, most of which was settled at the spot markets. Associate Vice President, Market Development and Regulation at the FMDQ OTC, Jumoke Olaniyo, now joins us to review the tradings for the week and, of course, talk to us about the anticipated futures markets. Thank you very much, Jumoke, for joining us on Capital Markets.
Thank you, Patemple. Always a pleasure to be here.
It's your first time, I'm sure, on Capital Market anyways, but
yes,
you've always been on Business Morning.
Yes.
Thank you for always making your analysis available to us. But let's take a look at what's transpired in the markets this week. We know that after 18 months of inactivity, the interbank FX markets, we've seen these interbank markets brought back now. And of course, the first 5 trading session began this week. Can you tell us what transactions looked like at this point? Because earlier on, we had that there was 1 day of appreciation, which is Thursday.
Kudos to the central bank, of course, for the guidelines that have reactivated this market. More so, kudos to them for taking up the challenge to, stabilize the currency with the intervention that they held on Monday, where they cleared the backlog of about 4 billion. As expected, Monday was a slow day because of that backlog, because of the uncertainty around how that backlog was going to be addressed. But of course, the central bank stepped forward and dealt with it quite decisively, if I might say. And thereafter, in fact, on Monday, despite it being late, the market agreed to trade late hours. And I think it's the sentiment going around everyone now. Everyone is doing the needful to just keep this market up and going. So our market dealers even agreed to trade late hours on Monday. They actually traded all the way up to about 5:30.
But couldn't that have been as a result of the backlogs in place?
Absolutely, but they could have just decided, well, we can't trade till 2 o'clock and that's the end of it. But they chose to trade even after the backlog, the SMIS event happened. And they chose, no, we need to show that our interbank market is up and running. And so they traded up to 5:30 interbank trades. And that set the tone for the levels we've seen in the interbank market. Following after that, throughout the week, the dealers have traded, albeit a little bit thin between themselves, but also we've seen the central bank recognizing that the market has been closed for almost 15 to 18 months, there needed to be some bit of liquidity to oil that market to start up again. So we saw the central bank come into the market, directly into the secondary market and intervene through its FX primary dealers as it had defined in its guidelines, and sort of put some supply, some liquidity into the market. And on the back of that, each day we've seen the interbank market also take off again when that liquidity came into the market. And so after that, Tuesday, we saw a little bit of depreciation of the currency further to about 284.85. But I think as markets and stakeholders generally in the market have begun to see the central bank's commitment as well as the dealing members' commitment to that market, a bit of confidence is coming back to the market as well. So that's why we saw a bit of appreciation of the Naira down to about 181.14 where it closed on Friday.
Right. Okay, so we know that the CBN, like you said, has been supplying these. But how sustainable is that? Because earlier, we heard Bismarck Rewane saying that, look, we need more activities in the market. How sustainable is the involvement of the CBN in these? Well,
the guideline says it's going to be a single interbank FX market, and it is not going to be a market led by the central bank. That they were very clear to say that. They were also very clear to say their role in the market will be an interventionist role, where there needs to be an intervention when there's a bit of stress or there's a bit of destruction in the structure of the market. The central bank would come in and do what it feels necessary to correct that structure. That's what an interventionist role is. And that's part of the mandate of the central bank, to stabilize the currency. So what is expected, or what everyone expects, is that now that we have a transparent pricing structure in the interbank market, and we can see where the currency are, now the suppliers of FX and those who demand the FX can now have a conversation to say, I can supply at this rate, and then those who are on the demand side can decide if they want to take it up at that rate. So I believe that as the days go by, more confidence is going to be on this market because there's going to be more transparency on the pricing. FMDQ publishes the closing prices daily,
on their
so
website.
everyone can see that. And that is going to bring confidence to those who have been holding back their currency. I am bold to say we're going to see FPIs come into our market back because there is that pricing mechanism now available. And that is the liquidity that is going to take up and run the market. That's the single structure that the central bank is looking to run. They are not looking to be the one leading the market or determining what the market should be. It is just expected that as the market is just starting, it's just 5 days after 18 months, they would need to be in the market a little bit more. But as the weeks go by, I think we're going to see less and less of the central bank's interventions.
Let me quickly raise this. Brexit is reducing the pound. Currently, we know that the pound has actually fallen to 30 years low. We've also seen Fitch rating. What do you make of impacts of this in the markets, in the FX markets?
Well, so in Nigeria, the FX market is not direct to pounds because the market doesn't trade the pounds directly. So the cross rates are what will affect that exchange rate. What I think we would see is what levels of investment volumes we would probably see from the UK coming into Nigeria, because I think on the back of the uncertainty in the UK, they might take a minute or two to decide what investment flows they want to flow back into the Nigerian market. So
okay, let me quickly cut on there because we don't have much time, but we really need to take this break at this time, and then we'll be back to continue the discussion.